Welcome back. There was a very interesting question that was posted by one of our subscribers. The question essentially is, since the Federal Reserve's paused on raising interest rates, why is it that stocks are continuing to go up? And I think the answer is not so simple. So we're going to try to tackle this. To understand the idea behind the Federal Reserve and what their purpose is, I just grabbed this from Investopedia. Congress explicitly states the Fed's goal should be number one, maximum employment, non-farm payrolls, unemployment rates low, things like that. Stable prices, which means not too much inflation or stock market bubbles, housing bubbles. Things should be stable. And moderate long-term interest rates, meaning that we should be able to go out there and buy a long-term bond, and get a good interest rate. But again, no bubbles, nothing that's really going to shock the markets. Well, the Federal Reserve is really, there's two sides of the economy that they have to watch. First of all is growth, gross domestic product, jobs market. They want to ensure that the economy is healthy, but they're not that the economy is so healthy that prices get out of control. So they raise interest rates to cool down the economy when it gets too hot. They lower interest rates to stimulate the economy when it gets too cold. The red line is the S&P 500. This goes from April 2018 through August of 2020. The black area charts the federal funds rate. Now, Federal Reserve had about a 1.75% interest rate in early 2018. The stock market was strong. We went up to highs of around 2.5%. During that period of time, the stock market went up. Now, the question again is that the Federal Reserve paused in raising interest rates. Why are stocks still going up? Well, the Federal Reserve paused in raising interest rates in 2019, and it would make sense from one point of view that stocks should go up when the Federal Reserve pauses in raising interest rates. The reason is stocks move in anticipation of higher corporate earnings. Disney makes more movies and sells more amusement park tickets, and Amazon sells more stuff on the website. So higher corporate profits. Now, what can hurt corporate profits? Higher interest rates. It makes it more expensive to invest, to borrow money, credit cards, things of that nature. The fact that the Federal Reserve paused in raising interest rates means that maybe some of us thought the Federal Reserve was going to continue raising rates for another year. This means that corporate profits now look better because they're going to pause. Maybe they're not going to raise interest rates at all anymore. So I think that now that at least for the next 6 weeks, the Fed meets approximately every 6 weeks, that now we know we don't have higher interest rates. That gives us a little bit of confidence that maybe our investments are going to do well. Now, with that said, stocks go up with higher interest rates because higher interest rates are also a signal that the economy is strong. It means that while prices are rising, there's still enough growth. There's still as many jobs out there as necessary to support those higher interest rates. That's why in between Federal Reserve meetings, we watch non-farm payrolls, GDP, inflation numbers like CPI, PPI, PCE, things of that nature, and all the other ones, construction and manufacturing figures, etc. Now, eventually, the stock market did turn to the downside. This big crash is the COVID crisis, March 2020, but we're talking about everything that happened prior to that. Stock market hit highs, very big highs, in fact, February 2020. The Fed had already started to lower rates. Well, the question is, lower rates, that's actually even better for the stock market. Maybe that's where we are now. Well, not yet. We're right here. Now, the Fed could also raise interest rates higher, or they could begin to cut. We don't know. We're going to have to watch the numbers to be sure, or to get a better idea. This is what the federal funds rate looks like right now. And you can see every step is of equal width over here. That's a 6-week period of time. Well, we're going to see a double because now the Fed has paused for the next 6 weeks. Stocks continue to go up and are very close in some cases to pretty historic highs, based in part on the fact that we have a little bit more confidence. These companies, if they could make money with the expectation of higher interest rates, they could probably make even more money now with the expectation of flat interest rates. Well, I always like to look at the bond market. The bond market really gives us a lot more detail as far as the mechanics of the economy. This is going back to 2018. Federal Reserve is raising interest rates. They pause at the top here. The red line is the 10-year Treasury. The black line is the 1-year Treasury. At this time, the red line, the 10-year Treasury, the long-term maturity bond, had a much higher yield than the short-term, and they're both going up. There's two components in my mind to the bond market: the spread between long and short-term interest rates and the direction of those lines. In this case, both lines are going up, and that the long-term bond has a higher yield than the short-term bond. That I believe to be a sign of a strong economy. But when the Fed paused interest rates, look what happened. The 10-year Treasury collapsed. And actually, at one point, we had a flat yield curve. The 1-year and the 10-year had the same interest rates. Now, flat yield curves don't last. They're very temporary. When we have a flat yield curve, that usually is a sign that something big is going to happen. Well, something big did happen. While the Fed paused interest rates, and those of us that don't watch the bond market says, okay, we'll wait for the Federal Reserve to tell us what to do. The bond market, the 10-year, had dropped from 2.5 to the next meeting was at 206, 50 basis points, half of 1%. The 1-year had dropped from 2.25 roughly down to 175. So the bond market had already really weakened in terms of yields. Now, take a look at the bond market present day. Black area chart, that's the federal funds rate. The red line in this case is the 1-year Treasury. It's important to note we have an inverted yield curve. The short-term maturity has a higher yield than the long-term. The black line is a 10-year. That's flat. Kind of goes up and down, but really it's flat over the long term. The red line, the 1-year, continues to make higher highs. What does that mean? That in the short term, the bond market expects higher interest rates. Maybe this is just a pause, and maybe in July, the next meeting, they're going to raise interest rates again. We're seeing a widening spread. So while the direction is up, well, the fact that the 1-year is higher than the long term, that's not good, because it tells us the long-term outlook is not as rosy as the short term. Might be sunny right now, but storm clouds are in the future. That's what the bond market's telling us. And by the way, going back to 2018 again with the bond market, notice the bond market, we had this pause, this top of the table over here for interest rates, and then bonds started to sink. Well, take a look. This is August of 19. Where was the stock market August of 19? Stock market August of 19 was making new highs. In fact, the stock market made new highs all the way until February of 2020. If you were to just take a look at the stock market at this period of time, obviously not knowing what would happen February and March of 2020, the stock market looked incredibly strong here. Well, March, let's say the beginning of 2020, January, what did January look like in terms of the bond market? Not good at all. That's when the stock market was at all-time highs. Federal Reserve was already cutting interest rates. And to answer your question again, it's a great question. The Fed paused in raising interest rates. What does that mean for stocks? Well, in the short term, the stock market, it went up more. But the bond market was telling us something different. So the answer to your question is that in the short term, I believe if the Fed pauses in raising interest rates, that's actually good for stocks, because it means that, okay, at least we're not going to have higher borrowing costs in the near-term future, the foreseeable future. But the answer really is good, but we have to watch the bond market, because during the period of time the Fed paused, the bonds dropped, the yields dropped. The Fed has now paused. What will the bond market do in the next 6 weeks? We'll make a mental note here. The 1-year is at a 527, the 10-year is at a 383. Where are these yields 6 weeks from now? I think that will really give us a clue. And the stock market can still go higher, but that could really give us a clue as far as the near-term future in the economy. Speaking of stocks, we don't spend a lot of time with technical indicators, but I think it's very important to do so. We have here the white line is the S&P 500. The red area chart is the RSI, the relative strength indicator. It measures exactly that, the relative strength of the market. Now we see readings above 70. Those are considered to be overbought, but the market can always go higher. And we see readings below 30, which means it's oversold, but the market can always go lower. But it does show us potentially extreme positions in the market. Now we see here, for example, the RSI crossed above and back below 70. This was August of 22. The S&P 500 had big highs at 4,300 and then went lower. The RSI crossed below 30 September of 22. S&P 500 hit lows around 3,600 or so and then went up higher. So that is typically what we look for. Just because the RSI is above 70 does not mean the market's going to turn tomorrow, but we should be aware of it because it means we're at a very extreme level. This is what the stock market looked like in 2019. And remember that stock market started to go down coming into 2020, or hit a top in 2020, right around that period of time. Now, this was actually May of 2019. Now, during that period of time, we see the S&P 500 was hitting levels around 3,000. The RSI was above 70, crossed back to the downside. This just gives us more of a close-up idea of how the RSI works in conjunction with the stock markets. This is a very long-term picture of the S&P 500. This is going back to 2016. The stock market's in black. The RSI over the long term, notice these lines that are just sticking above the 70 level. We're over here right now. The RSI currently is around high 70s, low 80s, around 80 of an RSI right now. When was the last time the RSI was at 80? Well, arguably maybe October, November 2021. And then we take a look at highs August of 2020, and then a very, very big high that was accomplished back January of 2018. But these are very significant highs, and you can line them up to see the tops of the markets when we hit those very significant highs. Of course, we haven't hit new highs in the S&P 500, but that's actually a little bit irrelevant because prices will change, stocks have splits, things like that. But the RSI really tells us the overbought, oversold picture. So putting all this together, what does it all mean? Federal Reserve pause in raising interest rates. Historically, it means that stocks could still go up higher, and they're very strong right now. From an RSI relative strength point of view, they're very strong. But we really, if we're trying to predict a long-term future, we have to see how the bond market reacts. And another element to this is that we have an inverted bond markets, where we have the long-term maturity below the short-term in terms of yields. We have to see the direction of those two yields and if they compress and what the bond market looks like. And we have economic numbers that we're going to watch because the Federal Reserve is also going to watch them in order to make their next decision at the next meeting. So certainly very interesting times and a lot of opportunities. We just have to sit back there and make a plan and wait for our spot. But we'll watch them very closely and we'll be sure to update you along the way. We hope this has been helpful. We look forward to seeing you back soon.